We have evidence of slowing stock market momentum. Is the deterioration similar to pre-plunge periods in 2008 or 2011? In this week's video, we'll let you be the judge. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We have a lot of charts to cover, so let's go straight to the videotape. In this week's video, we'll show numerous charts that allow you to compare the present day to previous corrections, 2012, 2011. This is a chart tracked by the CCM market model. We're looking at small caps weekly here in isolation. Bullish look, price above blue, blue above red, slopes up. Bearish look is a mirror image here. Bad things happen. Slope rolls over. Bad things happen. Price below. Bad things happen. This is small caps. Investors tend to gravitate towards small caps and riskier companies with a higher risk-reward ratio when they're confident about future economic outcomes. 2011, small caps went sideways for 5 months here. This point here is the exact same point as this point here. No progress prior to this waterfall decline. In 2012, stock market was rising. We have a divergence in small caps. Yellow flag was waving for 3 months here prior to this decline in the S&P 500. Let's compare this 5-month period and this 3-month period to the last 5 months. This is the last 5 months here, the top green arrow, and this is the last 3 months. You can see the present day really looks nothing like this period or this period or this period. It doesn't look anything like this period, or this period. We'll keep an open mind, but it is what it is, and momentum on this chart has not dropped below -20. This is a weekly chart of the S&P 500 index. The takeaways will be we have evidence of slowing momentum, which means the odds of weakness or consolidation in the coming weeks are increasing. It's important that we keep an open mind and keep a tight risk management strategy close at hand. We reduced risk this week, which tells you a lot about what we're seeing in the short term. Big picture, CCM market model has 5 submodels. The 2 that carry the heaviest weights scaled from 0 to 100. Submodel A is at 58, which tells us that 42% of the inputs in this model are now bearish or concerning. And that aligns with this slowing momentum and increasing odds of weakness in the short term. However, 58% of the answers to the questions are still bullish. Submodel B, that carries a lower weight, but slightly lower than submodel A in the CCM market model, on a scale of 0 to 100, is still at 78, which means only 22% of the answers to the questions are bearish or concerning, while 78% remain bullish. The takeaway is the cracks we're seeing are associated with slowing momentum. The longer-term outlook still remains bullish. And what that may mean is if we see weakness and consolidation, it may look something more like a typical correction than something of a waterfall plunge that happened in 2011. So let's review some concerns about momentum. This is a momentum indicator, Williams percent R, used in the CCM market model. The market model uses custom settings. These are standard settings, but the concepts are the same. Williams percent R and overbought on a weekly chart. Good things tend to happen in the stock market where the cursor is. The odds of bad things happening increase when Williams percent R moves out of overbought territory as it did here in 2011. Here in 2012, this is the stock market dropping. And here again late in 2012. We have some concerns. We've dropped below, and we have a bearish divergence here. When the stock market made a higher high, the indicator made a lower high. That's slowing momentum. The true strength index, again, we use radically different settings than this, but the concepts are the same. 2011, stock market goes sideways and then falls. Indicator gets a bearish cross, yellow flag of declines here that came much later. This is a negative look with black below red. Negative look, stocks are weak. Negative look, stocks are weak. 2013, this looks very weak, and this is your slowing momentum that says keep an open mind about what happens here in the short term especially. Stochastic RSI is a little bit like your standard RSI on steroids. This is weak momentum here. It's a negative sign when this rises and cannot get back to overbought territory. So this is slowing momentum that foreshadowed this decline in 2011. This looks similar to the present day, which tells us to be open to further weakness or consolidation in the short term. This is a weekly chart of the S&P 500 index. Slope of the 22-week moving average is tracked by the CCM market model. Point of the exercise: bad things tend to happen when the slope of the 22-week rolls over, as it did during the debt ceiling and budget negotiation / downgrade crisis in 2011. Rolled over here and rolled over here, foreshadowing weakness. Present day looks absolutely nothing like this yet. However, bad things can happen when the slope of the 22-week is rising. Correction, correction. What it tells us is this is a shorter-term correction where the market rebounds very quickly. Correction and a rebound. When the slope is up, the trend is stronger, and the corrections tend to be shallower, and the rebound tends to be faster. That's what we have now. So this slope doesn't tell us we can't see weakness. It just says this market in the present day looks a lot better than it did here. This is a daily chart of the S&P 500 index, and we're looking at the 50-day moving average in blue and the 200-day moving average in red. This is simple stuff, but it's very useful, especially if you track it in a binary way, answering questions. A bullish look is blue above red, the slopes of both moving averages up and price above both moving averages, and good things tend to happen. A bearish look is just the opposite. Price below both moving averages, the slopes of the moving averages rolling over, and bad things tend to happen. Present day, slope is bullish. Price is above the 200-day. Slope here is getting a little tired, but it has not rolled over, and price is still above the 50-day. Let's contrast that with 2011 when we were going through a debt ceiling issue. Well before this waterfall plunge, the slope of the 50-day moving average rolled over and stayed down for literally months in this period here. It's a daily chart. We had a bearish death cross here in 2011 where the 50-day crossed below the 200-day. And you'll notice the slope of the 200-day was flat here when really bad things started to happen. We don't have any of that in the present day. Even in a more modest correction scenario, price drops below the 50-day relatively early in the correction. and the slope of the 50-day tends to roll over, indicating a weak intermediate term trend. Price below, slope rolling over. Present day, price still above. The slope has not rolled over yet. So the answer to the observable evidence questions, the binary questions, price above 50, the answer is yes, bullish. Price above 200, yes, bullish. Do we have a death cross? No, we don't, bullish. Slope of the 50-day, flattish, that's a little concerning. Slope of the 200-day, bullish, yes. Slowing momentum is a concern. The basic takeaway from this week's video and the charts is that the big picture looks much, much better than it did in 2011, but we do have slowing momentum that's still concerning. And here's some observable bearish developments that show slowing momentum. This is the Dow Jones Industrial Average daily. This is a 50-day moving average here that we use to track the intermediate term trend. Notice the volatility here on a daily chart. And this enables us to really get a much better feel of what the trend looks like. As you can see here, the slope of the 50 here is much more bullish and pronounced than it has been recently. And this is indicative of a slowing trend. Answer to some of these binary questions don't look so great. Slope of the 50-day has turned down and price is below, which tells us to keep an open mind. This is another weekly risk-on, risk-off ratio tracked by the CCM market model. We're looking at XLY, the consumer discretionary ETF, relative to XLP, consumer staples. We like to refer to this as Tommy Hilfiger versus toothpaste. If you prefer, I am confident versus I am nervous, risk-on versus risk-off. 2011, the ratio foreshadowed this waterfall decline. Stock market moves sideways. This ratio was very, very nervous and declining. We also have a bearish cross here well before this decline and another bearish cross here that could have helped you with the ratio. Does this period here, where this is declining, in 2011 look anything like the present day? No, it doesn't. Price above blue and red slopes up, blue above red. In fact, if I compare the slope of this arrow, so the slope of the ratio in 2011 prior to the plunge versus the present slope, which is exactly what these two arrows do. This arrow is parallel to this arrow. This arrow is parallel to this arrow. You can see the slopes look radically different, which tells us something about the battle between Tommy Hilfiger and toothpaste. We mentioned on the previous chart that the readings on the CCM market model still show that the majority of the answers to the questions remain bullish. This is a monthly chart of the S&P 500. It's a chart used and tracked in the CCM market model. It looks at the EMA 3 and EMA 10, EMA 3 in blue, EMA 10 in red. This is what a bullish situation looks like. Price above both moving averages, slopes up, blue above red. This bearish cross occurred early in the dot-com bust and was an excellent risk management tool. It occurred here way before all of these declines. This is a bullish cross. Financial crisis, also very, very helpful. Bearish cross, bearish look. Never told you to get bullish until 2009. Good things happened after that signal. We have a bullish breakout from a 13-year consolidation pattern that is still holding. Good things tend to happen, as we mentioned earlier, when price is above both moving averages, blue is above red, and the slopes are up. Well, that's still what we have today. Price is above both, the slopes of both are up, and blue is above red. Doesn't really look anything like a pre-disastrous period like this yet, nor does it look anything like a pre-disastrous period like this in 2008, and this is the year 2000. In fact, September was supposed to be the worst month of the year in terms of seasonals. So far in September, we're up 3.6%. I think what that underscores is biases hurt performance. If it had been drilled into your head that September was a bad month, your bias heading into the month was to be bearish, and so far you've missed a lot of upside. Since we're looking at similar concepts, we can move relatively quickly on this chart. This is a daily chart of the NASDAQ Composite Index. You'll notice in 2011 here, this is 2011, before this waterfall plunge, the slope of the 50-day moving average turned over well before, raising yellow flags here. The slope of the 200-day moving average also started to flatten out, and there was a flat 200-day when we crossed through it, which was very concerning. We also had the death cross. Slopes roll over here before bad things happen. Slopes roll over, bad things happen. We don't have any of that as of the close on September 27th. We'll keep an open mind about where we go from here, but this is observable evidence in a market that recently made a higher high. It's pretty obvious as we go through the charts that these are helpful things to monitor. How do we monitor them in an unbiased manner? We simply answer binary yes or no questions about the charts, and then we convert it to a single number scaled between 0 and 100, which makes it very, very usable to compare the present day to historical market profiles. This is another risk-on, risk-off ratio tracked by the CCM market model. This is the S&P 500 risk-on relative to the VIX or the fear index risk-off. When the ratio is rising on this monthly chart, the S&P 500 tends to rise as it did here. This is the S&P 500. This is the ratio of SPX to VIX. This is what risk off looks like when the ratio is falling. All things being equal, the S&P 500 tends to be weak. You'll notice here in 2011, the ratio starts to fall, and it crosses below the moving average, and the slope rolls over. These are all bearish events here, and the stock market fell quite a bit further after these observable changes. Slope down, price down, drop below. Let's look at the present day and compare it to 2011. This is 2011 with a yellow flag here for several months. This is falling. Slope rolls over, price below. We don't really have any of that in the present day. Here's the concern we do have. We do have slowing momentum, and we have to keep an open mind about where we go in the short run. Could this chart morph into something that looks more like this? Sure, it could. But we need to see observable evidence. The slope of this has turned back up, and price is above it as of the close on September 27th. This is a weekly risk-on, risk-off ratio tracked by the CCM market model. We're looking at a high beta stock, Parker Hannifin PH, relative to a double short. So this is almost risk-on versus risk-off on steroids. The purpose of looking at this, it moves very quickly, much faster than a lot of the other signals, and can be helpful. 2011, here's your waterfall plunge in the stock market. Notice several months before the waterfall plunge, we get a bearish moving average crossover on this ratio, and we have a divergence here with the S&P 500. The present day, we don't have anything that looks like this prior to this plunge. Divergence, don't have it. So weekly risk-on versus risk-off ratio used in the CCM market model, we're looking at weekly stocks risk on relative to bonds or risk off, or SPY, the S&P 500, relative to the AGG ETF, which is a diversified basket of bonds or fixed income instruments. When the ratio rises, all things being equal, good things tend to happen in the stock market. Let's compare the present day to the waterfall declines in 2011 or even a correction in 2012. Here in 2011, this is the S&P 500, this is the waterfall decline. We have a bearish divergence on the ratio, telling us that as the stock market moves sideways, the demand for bonds was increasing relative to the demand for stocks, which says the ratio was getting more defensive before the stock market plunged. You can see here in 2012, if we just look at price, we have an upward sloping trend line in the S&P 500 that's broken well before this plunge. 2011, looking at price in isolation, upward sloping trend line broken well before this plunge. Present day, price, we have an upward sloping trend line that has not yet been broken. We also have a ratio here that looks much better than the ratio here. Instead of having a bearish divergence, this ratio recently made a higher high on a closing basis. Here, we get a bearish moving average crossover well before this plunge. Here, we get a bearish moving average crossover relatively early in this corrective process. Slope is moving down, bearish crossover, correction. We don't have a bearish crossover yet. However, bonds did outperform stocks last week as of the close on Friday, September 27th, and we also have slowing momentum for the ratio. Slowing momentum, eventually bad things happened. Slowing momentum, bad things. Slowing momentum, bad things. So we have to keep an open mind, but the longer term outlook presently is much, much better than it was here before this significant decline. We would guess, and it doesn't matter what we guess or think, that any correction would most likely be shorter in duration and less pronounced than what we saw in 2011, based upon the differences between this look and this look. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.